In 2021, a man named Warren Buffett paid a lower federal tax rate than his secretary. He said so himself, publicly, in front of cameras, with no apparent embarrassment. His secretary earned a salary. She paid income tax on that salary, somewhere between 22 and 37% depending on the year. Warren Buffett earned most of his money through investments. He paid 15%. She worked for him. She paid more. I have spent considerable time observing human systems, economic ones especially, and I will tell you, this is not an anomaly. It is not a glitch. It is not an oversight that has somehow survived decades of reform attempts and bipartisan outrage and Senate hearings. It is the system working exactly as designed. Let me explain why. Not with outrage. Outrage is not particularly useful here, but with precision, because the mechanics of how this happens are, once you understand them, far more interesting than the headline. There are two kinds of income in the American tax code. The first kind is called ordinary income. This is money you earn by working, a salary, a wage, freelance payments, tips. If you earn $60,000 a year at a job, that is ordinary income. The federal government taxes it on a graduated scale that currently runs from 10% at the bottom to 37% at the top. The second kind is called capital gains. This is money you earn by owning things that increase in value, stocks, real estate, businesses, and then selling them. If you bought shares of a company 10 years ago and sold them today for a profit, that profit is a capital gain. The federal tax rate on long-term capital gains, assets held for more than 1 year, is a maximum of 20%. For most people who have capital gains at all, it is 15%. Ordinary income, up to 37%. Capital gains, maximum 20%. This gap, this single quiet distinction between how earned money and investment money are taxed, is the foundation of almost everything you need to understand about why the wealthiest people in America consistently pay lower effective tax rates than the people who work for them. Now, here is where it gets structurally elegant, and I use the word elegant deliberately, because whoever designed this was very good at their job. The wealthiest Americans do not primarily earn salaries. They earn returns on capital, dividends, capital gains, carried interest. The value of their assets appreciates year after year, and as long as they do not sell, as long as the asset sits there growing, none of that appreciation is taxable at all. A man with a $50 billion stock portfolio pays exactly $0 in federal income tax on the growth of that portfolio in any year he does not sell. 0. His wealth is increasing by millions of dollars per day. His tax bill is nothing. This is not illegal. It is not even aggressive tax planning. It is the default behavior of the system. The tax code in the United States only taxes realized gains, meaning money that has been converted to cash through a sale. Unrealized gains, the increase in value of something you still own, are not income under current law. He does not sell, he does not pay. And he never needs to sell, because there is another mechanism. It is called buy, borrow, die. And it is one of the more ingenious financial strategies I have encountered in a lifetime of watching humans move money around. Here is how it works. You own assets, stocks, real estate, a private company, worth, let us say, $1 billion. Those assets are growing. You need cash to live on, to buy a yacht, to fund a political campaign, to purchase an additional newspaper. But if you sell the assets to get that cash, you trigger a capital gains tax event. So, you do not sell. Instead, you walk into a bank and use your assets as collateral for a loan. The bank lends you $50 million at a very low interest rate because you are an excellent credit risk, being a billionaire, and you live on that loan. Loans are not income. Loans are not taxable. You now have $50 million in spending money and a tax bill of zero. The interest on the loan is also, in many cases, tax deductible, meaning it actually reduces your taxable income from other sources. You continue to hold the assets. They continue to grow. You take out another loan against them when you need more cash. The loans are backed by an asset base that is expanding faster than the debt. And then, eventually, you die. When you die, your heirs inherit the assets at their current market value, not the value at which you originally purchased them. This is called the stepped-up basis. The decades of unrealized capital gains, the growth that was never taxed because it was never realized, are simply erased at death. Your heirs sell the assets, pay capital gains only on growth that occurred after they inherited them, and the original tax liability vanishes. Buy, borrow, die. The assets transferred across a generation. The tax bill never materialized. Now, let's add one more layer, because the story doesn't end with investment income. For people who earn money by managing other people's money, hedge fund managers, private equity executives, venture capitalists, there is an additional provision in the tax code called carried interest. Without going into exhaustive detail, carried interest allows investment managers to classify a significant portion of their compensation, the fees they earn for managing funds, as capital gains rather than ordinary income. A hedge fund manager who earns $50 million in fees this year does not pay 37% on that money. He pays 20%. Because of how his compensation is classified, not because of what it actually is. The carried interest loophole has been debated, attacked, defended, and nearly closed approximately a dozen times in the last 20 years. It survives, every time, with reliable consistency. Here is the number that puts all of this in context. ProPublica in 2021 obtained years of confidential IRS tax data on the wealthiest Americans. Their analysis found that between 2014 and 2018, the 25 wealthiest Americans saw their collective wealth grow by $401 billion. They paid a combined federal income tax of $13.6 billion. Their true tax rate, taxes paid as a percentage of wealth increase, was 3.4%. A teacher earning $60,000 a year pays an effective federal rate of roughly 22%. The 25 wealthiest Americans, 3.4%. A school teacher, 22%. There is no mathematical error in those numbers. I checked. The defense of this system, when it is offered, usually goes one of two ways. The first argument is that taxing investment income at lower rates encourages investment, and investment creates jobs, and jobs are good for the economy. This argument has been tested repeatedly over decades of tax policy. The evidence that lower capital gains rates produce meaningful increases in productive investment as opposed to financial speculation is, to put it charitably, contested. The second argument is that capital gains represent money that has already been taxed once as corporate income before it reaches the investor. Double taxation, the argument goes, is unfair. This argument is more technically interesting. It is also applied with remarkable selectivity. The worker whose paycheck is taxed, who then spends that money at a store where the transaction is taxed again, nobody seems particularly concerned about his double taxation. Both arguments exist. Both have been debated for decades. The system remains. Zoom out. The American tax code is approximately 74,000 pages long. It was not 74,000 pages long by accident. It grew over decades through an accumulation of provisions, exceptions, deductions, credits, and classifications, each one individually defensible, each one lobbied for by someone who had a great deal to gain from its inclusion. The result is a document that is, in practice, navigable only by people who can afford to hire teams of specialists to navigate it for them, which happens to be the same group of people who benefit most from its structure. This is not a conspiracy. It does not require one. It requires only that the people with the most resources consistently invest a small fraction of those resources in shaping the rules under which their resources are managed. It is, in its own way, the most rational possible behavior.
So here is the question that sits uncomfortably at the end of all of this. The tax code is public. The buy, borrow, die strategy is publicly documented. The carried interest loophole has been front-page news for 20 years. ProPublica published the actual numbers. Senate hearings have been held. Reform bills have been introduced. And the system has not changed. So the question is not whether people know. They know. The question is whether a system this durable, this resistant to reform despite this level of public awareness, is broken, or whether it is, from the perspective of the people it actually serves, working perfectly. The secretary is still paying more. She always was.